Hello everyone, thanks for joining us. My name is Uzoma Okafor. Now, this article discusses the capital gains tax under the Nigerian Tax Act 2025 as a key consideration in upstream asset deals. One of the biggest changes is the overhaul of capital gains tax under the new Nigerian Tax Act. Previously, capital gains were taxed at just 10%, which was rarely a deal breaker in structuring upstream asset deals, considering that upstream transactions are usually driven by operational, security, and regulatory considerations rather than CGT implications. However, under the new Tax Act, capital gains tax is now aligned with the company's profit tax rate. What does this mean? It means that taxes on your gains could be 30% for upstream companies operating under the Petroleum Industry Act, which is the PIA, and it could also be as high as 85% for companies operating under the PPTA, which is the Petroleum Profit Tax Act regime. Now, this overhaul has a direct implication on both international oil companies looking to divest onshore and shallow water assets, as well as indigenous companies which are acquiring these divested assets. For the international oil companies, transactions that previously attracted relatively modest tax exposures may now be subject to materially higher tax exposures, thereby increasing the overall fiscal cost of asset disposals. For example, where an IOC disposes an upstream asset for, say, $1 billion and makes a capital gain of $400 million after all necessary adjustments has been made. Under the old regime, CGT at 10% would be about $40 million. However, under the new regime, CGT at 30% would be $120 million. And for companies still operating under the PPTA regime, it could be as high as $340 million. On the other hand, for indigenous companies who are the natural buyers of these divested assets, the challenge is just as real. Now, in a bid to recoup the higher costs arising from the change in the CGT Act, these IOCs may decide to push the burden to the indigenous players through deal pricing, making acquisition more expensive for these indigenous companies. And considering the currency volatility, other macroeconomic challenges we have in Nigeria, it may be difficult for these indigenous companies to raise affordable capital. Now, the question is, what can companies do? To manage the fiscal impact of this change, there is a need to evaluate different deal structures like the share sale versus the asset sale. Companies may also consider exploring staggered transactions or earnouts. And above all, companies should engage the services of tax advisors from the beginning of the transaction. As you can tell, there could be an opportunity to explore potential rollover reliefs and some exemptions that may help reduce your potential tax liabilities. In conclusion, capital gains tax has now gone from being a footnote to a front page issue in upstream asset deals. It's important for companies to seek guidance from qualified financial, tax, and legal advisors or professionals such as Andersen. With expert advice, careful planning, and proactive positioning, both the international oil companies and the indigenous operators may not only manage their CGT burdens, but also unlock sustainable long-term value in Nigerian evolving energy landscape. Thank you for watching our Andersen Digest podcast. To read more on our article, kindly visit our website and click the subscribe button below. Bye!